Should Krispy Kreme stock be part of your investment journey? Krispy Kreme stock just went public, DNUT. I am a skeptic. I am a buyer of the donuts, but not the stock. That said, I was surprised to see the revenue growth that they put up over the last 4 years. I'll talk about how they were able to effectively double their revenue over the last 4 years. Quite surprising for a huge legacy brand like Krispy Kreme. Been around for decades. I'll also talk about the valuation at the end of this video. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. We're looking for potential multi-baggers, stocks that could potentially go up hundreds or even thousands of percent over time. So let's dig into Krispy Kreme and the latest developments, where here it is, the stock price below its initial planned range of 21 to 24 bucks a share, opened around 17, then popped back to 21. So first of all, this matches my own skepticism as I was looking at Krispy Kreme, or I heard about it. I was like, wait a second, Krispy Kreme's going public again, really? And so seeing that, then that a price below the range, that piqued my interest, saying, hey, yeah, maybe there's some sort of opportunity here. Maybe they're rolling out in some international market, putting up some great growth figures. Who knows? And so I was super skeptical. I just wanted to, take a look myself. Who the heck, while it might not be part of my journey, maybe it's part of someone else's. Some folks have been attracted to meme stocks lately, so maybe this is the next meme one. But the chain first went public 21 years ago during the dot-com bubble, and that in and of itself strikes me as another warning sign, because maybe this is just the type of company that goes public whenever the market's frothy enough to support a glazed donut company. And since then, when it was public in 2016, Jab Holdings, an investment arm of the Ryman family, took Krispy Kreme private for $1.4 billion. Put that in perspective, it's currently traded around $3 billion valuation. So that is a nice gain for them. And it makes you wonder what's happened that warrants that sort of premium valuation. And is it possible that it's just the market? So far, they have put up much higher revenue figures. That said, we need to talk about what's the underlying profit, and we'll talk about that in a second. Then the CEO today on CNBC talked about how the transformation that this company has done in the last 5 years, has been incredible. And I'm thinking, this is an 80-plus-year-old brand. I mean, how is there possibly a transformation going on with Krispy Kreme? And sure enough, look, they did double their sales from 2016 to 2020. So that is an accomplishment. I mean, a 19% revenue CAGR should get your attention for a consumable brands business. I mean, that does strike me as interesting. So I do want to learn more, and that's the purpose of making this video, so you could understand, sort of having an insider's take on, let's actually understand, how these businesses work, not just the headline figure that might get people excited. And so to understand the company, one should first understand their mission, which is to become the most loved sweet treat brand in the world. They do have some strong loyalty, with about 73% of their surveyed customers saying that they would prefer Krispy Kreme brand to all the others if they had to pick just one. They do have a strong product recognition, with 94% brand awareness and 64% of their donut sales purely this original glazed. But the question remains, wait a second, you've been around for 80 plus years. How is it possible for you to grow or expect to grow in the years ahead? So they have a few key initiatives here, one of which is more special occasion products, more reasons to bring you into the store effectively, whether or not it's tied to holidays or creating new holidays or events like the Mars Donut, one day only. And, Easter products. So they're trying gimmicky things to get people to come into the store for special occasion products. That's the way to the limited edition products. And then they also acquired a controlling interest in Insomnia, a cookies and ice cream brand that focuses on e-commerce or delivering it to you potentially late at night if you have a hankering or a craving for a special treat. I certainly appreciate that special craving treat. And they also have considered international, as well as expanding in additional markets in the US, such as New York, Chicago, Boston, Minneapolis, as well as China, Brazil, and Western Europe. And the part that gets me on this is, if arguably you could win in one of these international markets, does that mean you could accelerate your revenue growth in the years ahead? So that does, make me wonder, is there additional potential here? Now, what about valuation? And this is where I'm going to do a quick 10-second plug, if you will, where, once again, if this is your first time tuning in, I do appreciate you hitting that subscribe button or hitting that like button if you enjoy learning about potential multi-baggers. If you want to follow my personal journey, go to unrivaledinvesting.com. First week of the month, I call it my full portfolio full portfolio, and later during the month I call out at least one potential multi-bagger type of stock where I think has potentially hundreds or even thousands of percent upside over time. There's also an exclusive Discord community as well for like-minded investors looking for long-term potential investment returns. And so let's get back into understanding this setup here. And so the key to understanding this, I believe, is diving into this revenue figure, because in order to value Krispy Kreme, you should understand, well, wait a second, what's actually driving their revenue growth? And so this is where it's sort of, well, wait a second, how much of this is real or revenue growth versus sort of artificial revenue growth, artificial flavors? And so, I'm looking at it, and yes, they did put up quite impressive 17, 21%, 23% revenue growth for the last 3 years. But the reality is their organic revenue growth, the non-artificial sweeteners, was only 1%, 5%, and 3% growth in the same period. So why is there such a huge delta between the reported revenue figure and their organic growth? What's going on here? And what the reality is, it's the difference is from acquisitions, where they were buying franchises that were under the Krispy Kreme brand and then operating them themselves. Now, previously, the only revenue that they would get from their franchises was a few percentage share of their top line. Now, keep in mind, franchises are a beautiful business model, because when you own the franchise, when you're the franchisor and you have a bunch of franchises paying you money each month, they pay you based on their top line revenue. It's not their profits. It's effectively a cost of sales for them. Maybe it's 3, 5, 10% that goes to the parent company, that goes to the franchisor, which in this case was Krispy Kreme. That is a very high margin, lucrative business. Those are the types of business I actually personally love to own, because you benefit from inflation over time, and it's a beauty. Now, the challenge with this is that the operating stores have much lower margin profile, because you don't get all this juicy high margin revenue, the franchise fees. And so this structure, by acquiring the underlying stores, that's going to bump up their revenue, because all that business that those stores were doing is now going to get recognized as revenue versus just the, let's say, 3 to 5% that was previously going to Krispy Kreme. Now you recognize all that revenue, but your profit margins are going to be much lower. So as I think about this business, I'm going to say, oh, okay, your growth prospects might be a little bit faster than I expected. Maybe organic growth is, mid-single digits at best, but your profit margins are also going to be lower, because you're effectively operating more stores yourself and not getting as much franchise fees, that really high margin income source. And so then the question is, well, wait a second, let's dive into this organic revenue with even greater clarity based on region. And here it's an interesting picture where Americans, even despite COVID, they were going into their donut shops, with 10% organic revenue growth in US and Canada. International, meanwhile, saw about a 20% decline. And so the question is, what does this look like in a more normalized picture? Maybe you see 3, 5, 7% organic growth in the years ahead. That's a question mark, but it does make me wonder, what does this look like in a more normalized basis? Now, what about margins? Trying to understand this margin profile. And as I look at it, it's super tough to get a clean shot of what their margins look like longer term. I mean, they do have this extremely adjusted EBITDA figure. By the way, I really don't like heavily adjusted EBITDA figures. I mean, an acid test of whether or not I'm going to like it is whether or not you're adding back share-based compensation, which is a real expense. You're getting diluted by that amount each year. So I see this, I'm not happy about it. I see these strategic initiatives that repeat each year, store closure expenses. Look, I mean, this is a real expense that's going to happen year after year. So it shouldn't, you're going to have new stores and you're going to have store closures. So to remove this sort of bothers me. And yeah, so all in, maybe, this is my guesstimate based on looking at EBITDA versus their adjusted revenue figure. I'm thinking maybe mid-single digit to high single digit margins, operating margins for their business. If you have a different take on what you think their margin profile could look like, I'd love to hear your thoughts there. So feel free to leave a comment below. So looking at this and thinking about this growth profile trajectory over the years ahead, in the years ahead, so currently around $21 stock price, which is once again a $3 billion plus valuation, you can see the revenue growth that they've had over the last few years of, high teens, low 20%. So then the question is, well, what type of revenue figure do they have this next year. You're probably going to get some benefit from COVID as, let's say, Europeans feel more comfortable to go back in and buy some Krispy Kreme donuts. And they did acquire some more of their franchise stores, which resulted in their first quarter revenue putting up a solid revenue growth figure of around 20% plus. So then the question is, okay, so how does that shake out for the year? So I'm penciling out 15 to 25%. That said, longer term, it's tough to, let's say, continue this behavior of just buying franchises out because you need to finance that with debt. And part of the purpose of this IPO was to take about $500 million in proceeds from the IPO to pay down the debt that they used to acquire these franchises. So I don't see this business right now, based on the profit and free cash flow that they're generating, as being in the position to continue this type of strong growth, given the fact that I'm wondering, like, well, wait a second, are you just going to lever up, or you could be borrowing a ton of money to buy these donut franchises, these franchise donut franchises? So that does affect what do I think is their long-term growth rate over, let's say, the next 4 years. So next year, let's say 15 to 25%, then let's assume an annualized rate somewhere between 5 to 15% in my low to high case. Margins, I'm assuming somewhere between 4 to 8%. Once again, love to hear your thoughts there. So then the end multiple 5 years out, once again, I'm assuming a range of, let's say, 12.5 times to 17.5 times. Part of this is just the fact that, look, this is a low margin business and this is a low organic growth business. This is a business that has needed to acquire their own stores to drive growth. And that, in my opinion, is sort of a one-off shot. And that honestly is not a great trade, in my opinion, as I'd rather have the super high margin franchise income and reinvest those dollars into something else that strikes me as super high return on investment. And so that's, I look at this and I look at the input, the output of these different assumptions, and I'm looking at a stock price from here that's down regardless of which scenario I'm looking at. In the high case, I'm saying it's down about 25%. In the low case, I'm saying it's down about 80%. So in my opinion, this is quite an ugly valuation, unless you think there's just something that I'm missing, such as a much higher margin profile or a higher growth rate. I don't see it from here, given that they're currently operating at what seems like, a loss when you factor in all these messy components that go into it, like strategic costs and things like that. So I'm not sold by it. That said, there are other stocks that I do find, to be compelling. I call them out exclusively to my Journey subscribers at unraveledinvesting.com. That said, occasionally I do post a video here about something I do find to be compelling. One example of which, I did a video on Alibaba, and so you can check that out as well if you're interested in that. In full disclosure, I own that. But for Journey subscribers, I do call out those potential multi-baggers. For example, a couple months ago, I called out a company that trades below liquidation value, and I think could potentially have 200 to 300% upside over time. That I would much prefer to a situation like this, where using this logical framework, I just can't pencil out an attractive return. Now, of course, could the stock price go higher or lower? In these days, of course, you get crazy things. That, maybe this becomes the next crazy meme stock that people get super excited about. It's not for me. It's not for my personal journey. If it is part of your investment journey, I'd love to hear it in the comments below. Thanks so much for watching. If you enjoyed this video, please make a point of hitting that thumbs up and subscribing. Thanks so much.